After mentoring people for, I'll say, about 6 months, something common I always hear from all of my clients is, where do I belong in the markets? There's so many different forms of trading, so many different forms of investing and capital and markets that people don't know where they belong. So now picture this. You have three different people. One is an investor. They bought a share. One is an options trader. They bought an option. And one is a futures trader, and they bought futures. 1 week later, they all started at the same amount of money, by the way. One is up 8%. One is up 300%. And the final person blew their entire account. Now, these people are trading the exact same market, maybe even trading at the exact same time. What is the only difference? The risk. So today I'm going to explain to you the safest to craziest forms of trading. So, by the way, this is the most common form, so you're not going to hear me talk about bonds. But I'll guarantee you, if you're probably watching this video, you probably know what a bond is already. Put money in, guaranteed this. We're not trying to hear that. I'm talking about active roles. So now I'm going to separate it into forms of trading, investing, options, futures. Let's get it. Now, before we actually determine all of this and get into all of this, we need to determine what is risk. Risk is what I would classify as things like time, leverage, emotional vulnerability. How much control do you have over the amount of money you're making? For example, an option is something we called a leveraged asset. This means that with a little bit of capital, you're able to get something way out of your league in terms of affordability. For example, with the option, you're able to control 100 shares of a company despite only being able to afford sometimes not even one. But there's always equivalent exchange. Because you're taking on this leverage, the risk is also leveraged on the other end. For example, if I'm able to turn $100 into $500 into such a short, simple time, that means that $100 could go to zero even quicker. So let's begin with the most easiest, simple form of investing: ETFs. What is an ETF? An ETF is a collection of different stocks and companies, the entire S&P 500, which is the top 500 companies within the US stock market. And all you're doing is placing money in this, and over time, it is almost guaranteed to be up over like a 10-year period. This is for people who are beginners, number one, so you can understand markets and how they move. This is also for people who are really busy or people who have a lot of risk in their lives. So this is something for people who don't want to take a risk, but also want to grow their money and let their money work for them at the same time. One advice I'll give to everybody should have a portfolio like this, or something in my section too, which is individual stocks. No matter what you do, investing, swing trading, I don't care. Always have a portfolio with ETFs and stocks in it. You can flip the money from the options and then put it into the ETFs or the stocks, because this is where the real long-term wealth is really made. Now let's start with the individual stocks. This is how I personally got my start. And this is how I'd really recommend for everybody to start. You begin by researching small companies, and you start learning terms like blue chip. What is a blue chip? A blue chip stock is a stock that has proven itself for a considerably long period of time. You ever heard somebody talk about Coca-Cola? Why is that? Because Coca-Cola, I think for the past 10 years, has been guaranteeing 10, 20% returns yearly. So this is personally how I got my start. So stocks like Coca-Cola, Apple, Microsoft, Amazon, companies that really guarantee you a certain return every single year. But I'm gonna be careful with this word. Guarantee is the wrong word to use, because whenever you're doing anything other than ETFs, nothing in this market is guaranteed. As a blue chip stock may fail, but the likeliness to fail compared to everything after this section is really, really, really mitigated. Now, for the third section, which I put swing trading. Swing trading is where you don't look at it. You're not as gambly as say an options trader, but you're within a section where it's like you expect a stock to move from point A to point B within a month time period. So let's retrace now. We started with the ETF. The ETF you could hold for years. Every 7 years, your money will double. With 100, you get a $200 by what's that? 2034 or 2033 if you bought 2026. Got you? Understood? Versus individual stocks, which can rise 30, 40, 50% every single year. But it's way riskier. And you don't really understand what is going on. Unless you're really invested and right there with the company. This is where you're going to have to start looking at things like earnings, researching the company, and see where this company specifically fits within society. Do you trust that this sector or this specific company is going to really build towards the future of where we're going as a civilization? Now we got option number 3, which is a swing trade. Now, swing trade is something vastly different from the other two forms of trading. There is more risk when it comes to this because an expiration date is clearly made. I'm gonna buy here and sell here, and the price between this is definite. I can't really hold for longer terms or longer periods of time. So this is where the risk exponentially increases because you could hold a stock for decades. As long as it doesn't get removed from the stock market, you're good. And ETFs is the same. You can hold an ETF for hundreds. I can't even say hundreds of years. You can hold an ETF for even longer because it's the entire market. So if the entire market crashes, I ain't gonna lie, you might have bigger things to worry about. But swing trading is different. As between point A and B, you're betting within a set period of time a stock goes up by a certain amount. So, for example, one of the biggest AI companies in China recently released model results and said that the AI performing better than ChatGPT and Claude, but for 1/10 of the price. Now, the same company in the same day was like, oh my God, we're going to start requesting to buy hundreds, if not thousands of NVIDIA GPUs. Now, as a swing trader, I'm going to be like, yes, this is bullish news for NVIDIA. Now, I'm not only going to use this news because then again, you need to also consider inflation rates, whether the Fed going to cut rates or not, and the overall trend of the S&P 500 during this period of time. But it is safer than something like an option because you have it for such a long period of time, and the concrete and the your reasoning behind this trade is way more concrete than say a day trade that just uses indicator and uses a slight amount of news, bullish or bearish days in comparison. Now we get into trading, day trading. Now I could split this up into two forms. Let's talk about the option, and then I could talk about futures. So option is way different. A day trader buys 7 DTE, 5 DTE, 3 DTE. I start to stay within that region because the theta decay, which is basically how much an option loses every single day, increases as the option may decrease, or the time frame, that the time period you have left in the option decreases. So I'm gonna lose $10 today, and by 2 days from now, I'm losing $30 a day. It's exponential. It's not a linear increase. This is very, very risky because you're basically gambling that this market has to make this change within a couple hours to, if not a day. It's similar to swing trading, but it's also very different because when you're swing trading, you're expecting the change to happen gradually over a period of time, or it might shoot up in a day and you sell, you get out of that contract. But a day trade, you need a specific action to happen in such a short period of time that is very risky. Whenever you're an options trader, number one, you need a very little responsibility. You need little responsibility. And also, I recommend that you be young and also have other forms of income to supplement the potential losses that you may face. Versus if I'm a swing trader, yeah, you can have some responsibility and then you may have some, but you also need some disposable income on the side. Versus if you're an individual trader, even if you don't have any disposable income, the money you put in your savings, I'll recommend you put it into a stock and the money, and the same thing with the ETF. So the risk is very, very different when it comes to trading versus investing. Now we have the craziest of them all, which is futures trading. When you have a futures trader, whether you're, or I'm speaking for people who futures trade with their own money, the amount of money you could lose in a set period of time is so astronomical that you won't, the human eye probably can't even react to how much you're losing. This is why they trade with things called stop loss, especially basically when this stock reaches this certain price right here, you're gonna automatically take me out. I honestly can't really recommend this to people because it's not personally where I would go with my money because the risk is so high that I can't really believe in futures myself. But I recommend you do your own research on this. But so far, futures is the most risky, as even setting your stop loss is a little bit too high. My guarantee that you lose money. And while it may not have an expiration, the the change in the amount of money you lose in a set period of time is so high that you really can't um guarantee certain amount of losses. For example, when I do an option contract, sometimes I could only look for 2%, 10%, 50% is crazy returns to me. Let me explain. Every single year, the S&P 500 only makes between 7 and 12%. That's on the best years. And you're telling me on one options contract, I'm getting that same amount of time within a day, an hour, even like a 5 minute period. Now you need to understand that this risk is leveraged, meaning that you are risking your whole money to make more, but the potential losses you may face are greater. So don't feel like it's free, or don't feel like it's completely like just easy. Everybody who puts their money in long term is stupid. What I recommend you do is master the ability to leverage risk while also taking that level, the profit from the leverage risking, put it into stocks and ETFs, which may grow exponentially over the years. One thing I would like to say, just to wrap it up, is never let your money stay stagnant. Stagnant money loses money. Always let you have your money running for you, whether that be an ETF, whether that be a stock, whether that be a high yield savings account. Always have your money working for you because when it's in your bank account, it's not doing anything. When it's in a stock, it might be going up a good 1, 2%. But it's not that 1, 2% that one time that really counts. It's that 1, 2% over the years. Because we're not trying to get rich quick. We're trying to build wealth for our grandchildren, grandchildren. Because this is what all the billionaires and the millionaires do. So if you're 18 like me, start early, join the community, like and subscribe. This is something new I'm starting, a new venture. And come on, let's get in the journey. Safety.